Welcome to Module 6 of Week 1. The topic is trust. Ordinarily, estate planning courses include trust halfway through the course or when they get to gifting, and I don't take that approach. I much prefer covering trust right at the beginning of the course because, again, trust plays such a big role each week in the material, and I think you have to understand what a trust is from day one. So let's get into it right away. Most of this course covers the use of trusts as they are very flexible and solve many of a client's problems. As I put it, this is a 21st century answer to problems and problems today, where most of the methods we see for estate planning go back, some of them 1,000 years, some of them 200-300 years. Most of the processes we go through are very process-orientated, filling in the blank type. Trust aren't. Trust tends to be very substantive-minded. And trust, again, is by far the most flexible and can solve many problems. It's also, in some cases, about the only tool you have. For example, in gifting, there's very few ways to gift, of which by far the best is probably trust. So let's look at trust. Uniqueness of trust. First of all, has separate legal and beneficial titles. In other words, the trustee has legal title, but not beneficial title, and the beneficiaries have beneficial title, but no legal title. So in many cases, you don't know who the beneficiaries are, you only know who the trustee is, and that can have advantages in itself. Second is we can have mature management of assets of people who are probably not as knowledgeable financially or mature financially. And third, we can use the trust as a vehicle to make changes. Now, a lot of people don't realize it, but if you are the beneficiary of a trust and you don't like what the trustee is doing, you can go to court and have the court take a look at whether or not the trustee should be changed, and there are situations I've seen where that happens, and probably the biggest reason for that is most people aren't trained as being trustees. Most people really aren't qualified to be trustees, and they probably don't do a very good job. So there are professional trusts. I think using a trust company or a bank is a great idea for trust, or using someone who's a professional trustee. And I've known CFPs who do nothing but handle trust. And it is a very complicated field. It's not something that I would recommend for the average individual. Trust separate the present interest also from a future interest. So I can have something that's going to go to my son Mike and then to his daughter Susie. And that's a vehicle for trust is very useful that way. And it's not a procedural document. It's strictly substantive from a standpoint. None of us in this room are probably qualified to make a will that would work in any state, but we're all qualified to make a trust that's valid in any state. It's very flexible. Term versus life estate. All trust must have a duration. I think one of the problems that trust has is there's not a lot of rules there, and it doesn't specifically call for a duration time period on a trust, which runs into the rule against perpetuity issue. So assuming that we do put a termination period on it, a term trust is for a specific definite period of time, and that should be stated in the trust. And it could be for an indefinite period of time based on some lifetime or subsequent event. So a life estate could be on the life of the decedent, could be on the life of a relative, could be on the life of your dog, but it's some undeterminable time or event, where as opposed to a term trust is for a specific period of time, 10 years, 15 years, or whatever. So if we want to say for 15 years or until the child is 35, that is a specific period of time, that is a term trust. If it's going to be on some indefinite period, that is a life trust. A remainder man is a third person who obtains the assets from a present interest. Or another way of putting it is a remainder man is a the future interest. And reversion interest means that the grantor gets the future interest, and that has a tax consequence. So if the future interest is going back to the grantor, it's called a reversion. If the future interest is going to someone who is not the grantor, the future interest is called a remainder man. What does a trust require? It requires a grantor, someone who writes the trust and is transferring the assets, a trustee, someone who has legal title and does not have beneficial title, and finally the beneficiaries. An unfunded trust is when there are no assets in the trust, where funded trusts have assets in the trust. And you'll find both types. I might note, for those of you in the insurance field, you're going to hear unfunded insurance trust. That means there's no assets in the trust besides the life insurance policy, where a funded life insurance trust has assets in the trust to pay the premiums. They are different than the usage than when we talk about unfunded trust and funded trust, from being a unfunded insurance trust and a funded insurance trust. And you have to be careful on how you use those terms. Types of trust is revocable versus irrevocable. Revocable means that it doesn't really leave the hands of the grantor, and until an asset leaves the hands of the trust, it is revocable and stays in the hands of the grantor. It is also going to be taxed to the grantor and treated as an ordinary asset of the grantor. An irrevocable trust, or irrevocable trust, depending on what part of the country you're in, is a transfer of ownership from the grantor to the trustee of legal title. It has tax ramifications. A revocable trust is not tax ramifications because it remains under the control of the grantor. Typical grantor, a revocable trust would, for example, be a family trust, or a personal lease shoe asset holding trust, Bob Smith asset holding trust. These are examples of revocable trust. Irrevocable is it's transferred to third parties and therefore has a taxable event. Inter vivos means it's a living trust. It's being used during lifetime. Testamentary trusts are set up by wills. So an inter vivos trust, again, would be another example of a family trust or an individual trust. Funded versus unfunded. Again, we used the term before. Funded means there's assets in the trust versus unfunded, assets not in the trust. There's a grantor trust, and let's be careful how you use the term, because a grantor trust could be any trust which is revocable. It could also be a trust that is irrevocable or irrevocable, but there's unacceptable controls that were retained by the grantor. So you have to know how it's being used. A simple trust means that it pays out all income to taxpayers, which means a simple trust pays out all income but does not have any charitable beneficiaries because they don't pay income tax. A complex trust is any other type of trust. So if we pay out all the income but there's a charity involved for part of that income, it's a complex trust. Or if you can take out some of the corpus or retain some of the income, it's a complex trust. And based on that definition, the simple trust in its last year being a trust is a complex trust. The difference is taxation. Differences in revocable versus irrevocable. A revocable trust is the most common. It can be changed or terminated at any time and is under the control of the grantor. They're very big in many states, I would say especially here in California. In California, one neighbor gets a trust and tells the neighbor about it, all of a sudden everybody in the neighborhood wants it. Irrevocable trust means the grantor has given up control and the trust becomes a separate entity. It has its own tax return. I might note there are very few cases that it makes sense to have an irrevocable trust set up, and you probably could get sued for recommending irrevocable trust unless you met some of those requirements. Those requirements we actually cover in week 4 as to when it makes sense to set up an irrevocable trust. As what happens is the grantor is giving away assets, and let's face it, many times people give away assets and the next day they change their mind then who do they blame? They blame you, the person who advised them. So it's very rare, and we'll cover that in week 4, what are the cases where irrevocable trust makes sense. Inter vivos versus testimony. Inter vivos trust controls assets during lifetime and serves as a will substitute. And those are the two functions. I can control my assets during my lifetime. They're located in one case, one place. I know where they are, and I use them as a tool. The key thing is to make sure the assets are in there. So if you have a house, the deed is in the trust. The deed calls out the trust as ownership of the property. Likewise, in automobile licenses, you need to have the license itself, registration, call out the trust, not the individual's name. And if you don't call it out, it's not going to be in the trust. So anything that requires a deed or a registration has to have the title change. And that's where people make a mistake. They don't do that. And the biggest part of their assets not included trust. And about a couple of years ago, had a personal situation where one of my clients had a large brokerage account in which he did not have a TOD, and quite honestly, the assets did not go where he wanted to go, and it would have been much better for him to have he didn't want to have a TOD, to have a trust in place, because he would have had some kind of control. Testamentary trusts are usually a creation of the will and only used after death. As I mentioned, funded trust has assets in it, unfunded trust has no assets in it. And you might say, well, where would you have an unfunded trust? Well, let's say your client came in today and said, I want to set up a trust for my family, and the first thing you do is you set up the trust. Then you add assets to it, and the assets might be jewelry, it might be the TOD account, it might be the real estate, the automobile, but they are added subsequent. Grantor trust, two definitions as I mentioned before. One is a revocable trust, is called a grantor trust, and also an irrevocable trust where the grantor retains a right, power, control, and thus is taxed to the grantor and not to the beneficiaries, is a grantor trust. You've covered that in your income tax course, and you're going to see it later on in this course also. So you have to be careful when you use the term grantor trust, how you're using that term. Simple versus complex trust. A simple trust pays out all of its income annually to a tax-paying beneficiary. Again, leaving out charities. Charity cannot be a beneficiary of a simple trust. Complex trust is to cover anything else. Might note that filling out the tax return of a trust that's a simple trust is very, very easy. Where a complex trust can be very, very complicated. It can be one of the most complicated tax returns of all, is if it's a complex trust. That covers our summary of trust at this stage, and the end of our module for week 1. And I would suggest, if you have questions on any of the areas, to go back and relook at the module. And make sure you understand it before you go on to take the test.